Live again on Clubhouse. We are live on Instagram. We are live on Facebook. My name is Otis James. I'm a real estate investor out of the San Francisco Bay Area. You guys know I spent the better part of 20 years in the multifamily commercial industry. I am a long-term hold investor. I'm licensed in insurance. I'm a licensed real estate broker in California, licensed broker in Georgia, ran a mortgage company. We funded short of $1 billion back when I ran Mortgage of the Rock with my father, who's been a real estate broker since 1971. I was overseeing 3,000 units here in the Bay Area. It's about $650 million in multifamily commercial assets. On the non-real estate related side, I took just under 600 bucks, created a company that went on to generate seven figures. I've had a notary signing agency. I've invested all over the country. I still do. I'm the founder of the 4 Data Points Academy. That's a real estate investing training platform with no end date. So it's unlimited support because our goal is to turn people into real estate investors. I do a whole bunch of other stuff that's way more impressive on paper than in real life. So welcome to the folks, excuse me, on Clubhouse, and, and welcome to the folks everywhere else. And shout out to that one person who subscribed to our YouTube page. I don't know, whoever you are out there, thank you. I was inclined to write you a nice letter to thank you personally for helping us break the internet with all of our subscribers. All right, so we're going to be talking about home equity lines of credit and home equity agreements. And we'll keep it informal. We'll get into any real estate questions that you guys have, but I did want to knock this out of the park first because, interestingly enough, this is something that kept coming up on my feed. I don't know what triggers the algorithm, but I'm always looking at different ways to teach how to finance real estate investing. And we have all the usual suspects, but home equity line agreement, a HEA, kept coming up over and over and over again. So I looked into it, and it's been around for a long time. It's been under different names, but it's basically, another way to access equity in your house. So with me, we may have some other folks from Data Points Academy coming and jumping in. We're probably going to do this for about 40 to 45 minutes, so we'll go a little short today. I've got my 3-year-old out there, and he's probably going to be walking in here in about 40 minutes once that iPad power dies down. So I tell you, man, that iPad is life for him.
Right?
And now he's going through that phase of he wants me to play with it. Right? Uh, what's up, Don Pill Method over on Instagram? I see you over there. Tavares, tell everybody where you from and where I was about to say where you from and where you at. Tell everybody who you are and where you from.
What's up, everybody? I'm Tavares Allen Garrett. I'm from the Bay Area. I'm the founder of the Body Synthesis. I'm a health and transformation educator. Also, I serve as the manager of student relations here at 4 Data Points Academy. I've known Otis and James over 38 years now. I spent about 10 and a half years in the multifamily industry. I've leased everything from residential to high-rise luxury products, and was also leasing units from the Bay Area to LA, in the Valley to be specific, Encino. And so happy to be here, man. Happy to serve. One of my specialties is vendor relations. Take care of your vendors so your vendors will take care of you, especially if you're in a pinch, right? We want them to come through and check that box for us. So welcome, everybody. Set your stage, get your tea, your coffee, your tea, whatever you drink in the day, and let's get it.
Hey, Don Pill Method, what's going on, brother? I see you on Clubhouse, man. You the multi-dimensional, man. One place and then the next place. That being said, we'll have a bunch of people coming in and out of here. This is going to be really, really informal. I'm starting to use this content to and piece part it. And you guys know, I think the internet is just super corny. I just, if you want to wake up and ruin your day, just browse the internet for about 10, 15 minutes. That'll be just enough time to put you in a bad mood. But it's a necessary evil, right? Because that's how we let people know who we are. And the more people that know who I am, the more opportunities I can create for people that wouldn't necessarily have them. And I don't just mean people that join our real estate family. I mean people out in the communities. It brings me a lot of fulfillment to do it. 4 data points. What does it cost? What does it cost to fix up? What's it going to be worth when I'm done? How much income can it generate? That is the foundation of real estate investing. If you're a savvy investor, whether you know it or not, you are answering those 4 questions. That is not the end all be all of due diligence. That's just enough due diligence to determine whether it's even worth your time looking into on a particular property. I just realized I'm gonna have to start getting, I'm always black t-shirt, black and yellow hat. You guys that can see me on the live stream. So I just realized I'm gonna have to start
You have to
getting.
tighten that up.
I'm gonna have to tighten it up. I'm gonna have to
You
start
got to
getting
tighten up
different
a little bit,
colors.
though.
Yeah, people that somebody asked me, they was like, "Hey, do you have a different shirt?" And I was trying to explain. I buy 20 and 30 of the same t-shirt. So
I'm right there with you.
Yeah, so I don't have to think about it. And if I'm traveling somewhere, then I don't like taking old t-shirts. I like taking t-shirts out of the plastic when I put on my suitcase. So
there you go.
I've got it's not like I've got a bunch of these. So shout out to the folks over at Classic T.
Oh man, that's what's up. Let's get it.
Yeah, I do absolutely have more t-shirts. So you don't have to ask. Don Pill Method, what's going on, sir?
Good morning to you. Listen, man, we haven't talked in a while. Did you put me down or what?
No, man. I thought I was like, dang, did I do I owe him some money? Because I can't get a hold of him. Did he think I'm gonna borrow some money from him or something? I don't know what it is. Oh man, but we glitching over here. I don't know what that is. All right, hold on 1 second, folks. Let me see how to deal with that. That's weird. What is that? Hold on. Yeah, I don't know what that is.
We got to get you an assistant, man, and be over there with you, working on all these platforms, man, answering these questions for you, bro. So we got to work there.
I know, man. I know. I wanted
to find an intern.
That's what I was about to say. Maybe we'll just do an internship. All right, hold on.
There you go. That'll work.
Hold on. We ain't doing no internship. I got to have somebody up on my house. All right, let me see. Yeah. That's a trip. Okay, let me see. Maybe it's the y'all bear with me. Let me work out this technical difficulty.
Shout out to everybody in the audience real quick. Hello, everybody. Hope y'all feeling good today. Hope y'all got that good energy today because, we're about to get into it. Please, if you have any questions, feel free to put and this is the form to do it in. So
let's get it. I appreciate you, sir.
Got you.
All right, now let's see what's going on. Let's see if I can get this webcam back up. Okay, I guess my webcam just went off. All right, well, let's see what. Hold on, y'all. Hold on.
Hey, shout out to you, for just having a good attitude about all this, man. That's what's up, man. That's a good look.
I don't get paid to do this.
But it's a good look, man. You have a really good attitude. A lot of people would be in a position right now and they'd be stressing out, right? They'd be bugging out, breaking off in the cold sweats. But it's really cool for everyone to witness you navigate, putting together your clubhouse room, streaming on multi-platforms. The job isn't easy, but my brother, kudos to you for making it happen.
Yes, sir. Yeah, look, this is free, right? And the information that we're giving out is pretty valuable. But whatever I did, I fixed it. So
nice.
Yeah, when you get over 40, man, all these buttons get intimidating.
All man, right. Let's go.
Especially when you're live, because you don't know if you're just going to cut everything off. All right.
Yep.
All right. So,
all right. Well, I like the topic, man. As you know, Otis, this is one of my favorite topics. I think that look, there's a lot of people out here that I guess if you say the professional real estate investors, people that have been doing it for a long time, but people who are just getting started, the reality is, I would say the most common way. I don't have any science behind this, but I just know from the people that we deal with, and we deal with a lot of people getting started in real estate. The single most common way that I see people getting started in real estate is by leveraging the real estate they already have, which is their home, right? The time and the effort and the energy and the hard work and the money that they put in to getting their own personal home, they leverage that in terms of the equity that they've gained, and that's how people get started in real estate. And so that's a great tool to use. It's a great tool to have. People have worked hard for it, and it's important to be able to do it the right way. And so I love this topic. I love that's what we're talking about today, because look, if you've worked real hard to be able to get that equity and to get your home, we want to take advantage of that. And you look, sometimes you only got one shot, right? And so there can be some pitfalls, and so we want to make sure we do that the right way. So great topic, oh.
That's what's up, and shout out to the people in the clubhouse room who shared the room. I appreciate y'all. Oh, 3 shares. Oh, and I shared 3 times. Oh, I take that back. None of you shared the room, so thank you. Thank you very much.
Hey, we have a question from Jermaine. Sorry to interrupt. You on the road this morning,
this is
man.
not good. We're not posting this. What's up, Jermaine?
What's up, Jermaine? So Jermaine says, Otis, how can I tap into my home equity if there's a second lien on the home? Yo, Jermaine, great question. Thank you for that. Get him, oh.
Yeah, you can still do it. The second lien really shouldn't matter. It's about how much equity you have in the house. So you may be able to do a home equity agreement, but let me so I researched a couple companies and there was some common denominators, so I took some notes.
Nice.
So I could bring it back to you guys. And I think I'll create an actual lesson on how to manage both home equity lines of credit and home equity agreements. And it's really just like anything else, right? Any other loan product. All loans aren't meant to do everything, right? Like loans are like tools. They're meant for to accomplish a specific thing. So somebody that's looking for a long-term situation and doesn't want to worry about any mortgages fluctuating and all that. Tavares, I'm getting some background noise from you, so I'm go ahead and mute you.
Oh, my apologies.
So somebody that wants like a long-term situation and they don't have to worry about it, and they want to understand how much cash flow, if it's an investment property, that they're going to get over, and they don't want any surprises, they do like a 30-year fix or 25-year on the commercial side. Somebody that wants maybe a better rate. They're not going to be in a property for, more than 5 years. Maybe they'll do an adjustable. So all of these products, if they're misused, they can come back to bite you. And you remember back the 2008 real estate debacle, everybody was getting on, all of the mortgage people, and there's enough blame to go around for everybody. But what happened was a lot of people were misusing these loans. They'd have a 2-year fix and then it would go adjustable, and when it went adjustable they could manage it because it rarely adjusted down. And and so people started pointing the finger, which is the world we live in, right? The victim always looks for somebody to blame, so we should get as educated as possible on these things. So I want to welcome Brandon. What's up, man? Haven't seen you in a bit. We got Don up here. We got some other folks in our real estate family. Looks like our invites just went out. I usually start this at 8:45 a.m. and then we start live streaming at about 9. This is California time, and so people will start pouring into the room. If you guys have any questions, feel free, put them in the chat. Tavares, if you don't mind, kind of monitoring the chat and seeing what questions come about, I'd appreciate it. You guys want to come up on stage so you can ask a question verbally, and I'm not worried about getting interrupted. The goal is to make sure you guys understand this stuff. And I've been doing this for a very long time. I can talk 8 hours straight for about real estate, and I'll just keep going unless somebody interrupts me or somebody jumps in, because what I want to avoid is
this dead air space.
That dead air.
So
See how uncomfortable that was?
Real quick, so we are on several platforms now, and so I want to invite people to follow us on the other platforms, especially YouTube, because you can be our 140th follower. So please follow us on YouTube. Here's the other thing: if you're on Clubhouse, where we started, I know I invited a bunch of you up on stage. I want to encourage you to come up, because when you ask your questions here on this platform, the people on the other platforms hear it. It's very helpful for them. So want to encourage y'all to do that. And please, I will put the link in the chat to our YouTube. Please, I want to encourage y'all to follow us on there. Go ahead.
All right, forgive me if I'm talking fast. I went to I got up early. I went to take a Red Bull, get a Red Bull, and I took the I ended up taking a pre-workout energy drink by mistake. So if you watch me live stream,
real quick, we have a follow-up comment.
Go ahead.
From Ron, I believe. Yeah, Ron. Second lien in the form of a HELOC. What's that? HELOC? Am I saying that right?
Yeah, home equity line of credit.
Okay, and then we have Robert Richardson. He says for an ADU in Los Angeles. I'm assuming he's asking, can he do the same thing for an ADU in Los Angeles?
Actually, I don't know. I don't know if you can do it. So there was some legislation that passed that to where ADUs can be treated as their own entity, and I remember it, but I forgot it, and I don't want to give you guys some bad information. So I don't know. I don't know. I've got to go back and research that. That's a good question. I just don't know, and I have an idea, but I don't want to put that information out and have it be bad. So forgive me for that, but I will look into it. And if you email me, I will get you an answer. But yeah, I'm not well versed in the how ADUs are treated in SoCal. That being said, a home equity agreement is a financial agreement between a homeowner and a third party, right? And so it allows a homeowner to get a portion of their equity, just like a HELOC would, but it's an alternative to traditional loans like a HELOC or refinance, and it does not involve monthly payments. So people really get excited about that. So the key features of a home equity agreement, and then I'll get into a home equity line of credit, which is a HELOC. Home equity agreement, you'll see them out there as HEAs. That's what they're called. So they don't have monthly payments. They do give you a lump sum payment, and they have a term, right? So they're usually a set term. For example, 10 to 30 years. If the homeowner does not sell or refinance the home by the end of the term, they're required to settle the agreement by either repurchasing the investor's share or selling the home. So how do you repurchase the investor's share? It'd be a refinance, right? So you probably have to do cash out refinance in the same way you would settle on if you were paying off a home equity line of credit, or if there was a balloon payment. So that's pretty straightforward. No debt added. So a home equity agreement does not count as a loan. So it doesn't increase the homeowner's debt to income ratio, right? Well, that's evidence because there's no mortgage payment. Shared risk. So the investor shares in the home's future. So if the home appreciates, the investor gains a portion of that appreciation. If the home decreases, the investor may receive less than the initial investment or even incur a loss. Good luck having homes depreciate out here in the Bay Area. I wish they would.
Yeah, that's right.
Yeah, they're not going. So, some of the common uses for home equity agreements are similar to what you would do if you did a cash out refinance or a home equity line of credit. You could pay off debt, you could do home improvements, cover large expenses, you can increase liquidity without taking on any new debt. That is important. That is really important. Increasing liquidity without taking on any new debt. So am I willing to sacrifice a percentage of the future equity in my home in return for being able to increase my liquidity? And as an investor, increase liquidity means we can put that money into more cash flowing assets. So there's, so that's a good thing for me. But again, it's important to get well educated to make sure that this product, this HEA, is not misused. Now, I'm not telling you whether they're good or bad. I'm just explaining what they are, and then you guys can make that determination for yourself. Tavares,
Questions?
Yeah, go ahead.
Yeah, Otis, but the thing is, isn't it true that you aren't in control of how much that's ultimately going to cost you.
This is true. Yeah, because you go into this agreement and it is a percentage of future equity. So the cash you get out may be eclipsed by what you have to give up once you exit out of your property. So let's say you sell the property and you got $50,000 cash for a percentage of the equity, and the increase in value is substantial. Well, you could be giving up 100,000, 150,000, depending on what it is, right? So, again, and I'll go over the pros and cons in just a second. I want to welcome some other folks to the room. Everybody in my real estate family, I see you guys down there. Feel free
Hey,
to go ahead.
Real quick, sorry to interrupt. We have I think it's another question from Brandon 1000. What's up, Brandon? Brandon says, would you use a property that you own 100% as collateral to buy more real estate? Thank you for the question, Brandon.
Always, 100%.
All right.
If it's an investment property, the goal, well, it depends on it depends on what you're trying to accomplish. What's your financial what are your financial goals with respect to wealth? And I'm gonna use wealth because the road to wealth is a lot quicker if you manage debt the right way. You can't save your way to wealth, right? You can get creative, and once you're really, really savvy as a real estate investor, and accumulate some wealth with very little capital. But again, I wouldn't build a business model around that. So I'll get into that. And you guys will. Let me give you guys a clearer picture. First, I want to go over the pros and cons. So on the home equity agreement, some of the pros, some of the good things. I said there's no monthly payment. You can get access to cash without taking a loan. You can cover large expenses like education and medical bills, and you can increase your liquidity without taking new debt. Okay. Now, what are the cons? What are the bad things? Right. So it can be costly if the home significantly appreciates. As well, the more it appreciates, the larger that third party investor's share gets, because the payback isn't based on a dollar amount, it's based on a percentage of the future equity. So if it appreciates a lot, guess what? Now that may be worth it to you, it may not. And I do want to reach out to my attorney to see what the tax implications are. My tax attorney, to see what the tax implications are of doing this, because I haven't researched that. So if we start getting into the tax conversation, just know that I'm giving you my best guess. Always vet this stuff with a qualified professional when we start getting into those things. I can only, discuss things based on my experience. The homeowner may owe more than expected if the home's value rises. Now, the issue with that is, let's say you have your personal residence and you get into one of these home equity agreements, and you sell the property because you want to buy another house. And you've got projections based on how much money you think you're going to get out of your house to accomplish that. Well, you may be surprised when you go to close and you see that there's a line item on there for a significant amount of your equity, right? And that could put a monkey wrench in your plans. Right? Now, it's limited to a percentage of equity, often 10 to 20%, and it requires selling or settling within a specific time frame. Now, look at it, think about it as a balloon payment, right? So a lot of you guys are familiar with balloon payments. So let's say you have a 30-year let's say you have a 30-year mortgage. It's amortized over 30 years, which means they stretch the payment out over 30 years and you make monthly payments. But there's a balloon payment in 3 years. That just means that the payment is based on a 30-year amortization, but the balance remaining at the end of 3 years, or when that balloon payment comes to fruition, needs to be paid, right? You got to pay off the remaining balance. So not too complicated, but it is what it is, right? Typical credit score requirements, because you're not taking any new debt and because it's based on the equity in your property, you can typically accomplish an HEA with a lower credit score, like 500 to 600, right? Now, there is some flexibility, but if the credit score you're trying to qualify is lower, then they're going to require you to have more equity based on my research. Again, I've never done an HEA, I don't know how I feel about it yet. I just, researched it because I was just interested in how it compared to a home equity line of credit. So the factors beyond your credit score, the equity in your home, the home's value, debt to income ratio, although it's less critical than for a traditional loan, it still may be evaluated, and payment history. So they're probably still going to look at your ability to make your regular mortgage payment. That I would think is important because now you have a third party investor in your property involved in the financial success of your property. And if you can't make the payments, then it's going to increase the risk for that investor because you could get foreclosed on, and that's going to impact the investor. All right. So HEAs, home equity agreements, are a lot more flexible. Now, how do you qualify with a lower credit score? So that's just what I was talking about. Got to have a strong equity position. You got to demonstrate financial stability. How you doing, Valerie? You got to consider alternative providers. Some companies specialize in working with lower credit homeowners and may have fewer restrictions. So a bunch of companies are offering this. So I would recommend shopping around just like you would shop around for a traditional mortgage. All right. Now, before I move on, is there any questions about an HEA, a home equity agreement? All right. By definition, I'll just read the definition to you guys. It's a financial arrangement between a homeowner and a third party investor or company that allows a homeowner to access a portion of their home's equity in exchange for a lump sum of cash. Some of the key features: there's no monthly payment. You get a lump sum payment. There's a term of the agreement, so you have to settle within a particular term. There's no added debt, so you're not making monthly payments on it, and you're sharing the risk with that investor. I tell you, man, it's hard to talk. I'm tripping up over my words with this pre-workout kicking in. I might have to do some push-ups up here on YouTube. Um, Common uses, same as a home equity line of credit or any uses that you would take care of if you had a lump sum of cash. Pros and cons: the good thing, like I said, no monthly payment. You get access to cash without taking out a loan. You can provide funds for, they provide funds for homeowners who don't qualify for traditional financing. Some of the cons: it can be costly if the home significantly appreciates as the investor's share increases. The homeowner may owe more than expected if the value rises, especially if you're trying to exit out of that property and go sell it to buy another one. And it's limited to a percentage of the equity. So that can be a big number, that can be a small number. Now, if you live in California where homes appreciate significantly, that number can be a lot larger. So you may want to exercise more caution in high cost areas. But if you live in an area where homes are significantly lower in value, then you may want to reevaluate it that way. Right? All right. Any questions about an HEA? Now I'll get into home equity lines of credit. Then I want to talk about investing with either if you have a lump sum of cash. Tavares, is there any questions in the chat? And anybody on stage? What's up, Angel? Anybody on stage have a question before I
Hey, Otis.
continue forward? Hey, lady. Were you just saying hi, or did you have a question, Angel?
Oh no, I came up on the invite because I'll probably have a question, so I'm already in
Oh,
place.
right on. Okay, I just want to make sure I didn't miss you. All right. Now, home equity line of credit. Home equity line of credit is my favorite next to, I don't know, it's like right up there with leverage and insurance. So, for those that aren't familiar with a home equity line of credit, I will read you the definition of what a HELOC is. It's a type of revolving credit secured by your home's equity. It allows homeowners to borrow money as needed up to a predetermined credit limit and repay it over time. HELOCs, or home equity line of credit, home equity lines of credit, are often used for large expenses like home renovations, debt consolidations, or other financial needs. Now, me as an investor, I'll use a home equity line of credit and put that money into more cash flowing assets that I can leverage to pay the home equity line of credit back so I can continue using it. All right. Key features of a home equity line of credit: it's revolving credit. So it's used like a credit card. It's secured by your home's equity, so similar to a HEA or a home equity agreement. And there's two phases. So let me break this down for you. So there's the draw period and the repayment period. Now, this is something that a lot of people don't understand about a home equity line of credit. The draw period typically lasts 5 to 10 years. So during this time, you can borrow funds as needed and may only be required to make interest payments. Okay, that's the draw period. The repayment period is usually 10 to 20 years. So during this phase, you can no longer borrow the funds and must pay back the principal and interest. Okay, so 2 phases. So if you guys are shopping around for home equity lines of credit, make sure you ask that question. What's the draw period and what's the repayment period? All right. What's going on, Tex? I see you come up on stage. What's going on, brother?
Hey, brother Otis, brother Tavares, brother James, and the family. Hey, Ice, Angel, and all. Hey, brother, I have a question about if I may back up to that home equity agreement. I have 2 questions. One is like not my most important question, but like, why are we just hearing about this now? Like, how long have these things been in existence, and like, why do we hear about it now? And the second question is, if your equity goes down, like if your home decreases in value, if hypothetically, of course,
Yeah.
but if your home does decrease in value, uh, does the investor's share remain the same? For example, if the investor,
Yep.
if you agree
Good
to
question.
50% of that equity going to the investor,
Mhm.
does that equity stay at 50%, or does the investor have to get his whole lump sum out?
Well, it's based on the equity appreciation. So, and one of the distinctions that I need to research is, well, based on what I did research, it's only a portion of future equity, right? Uh, but again, I haven't talked to enough banks to pin down this distinction. It's only a portion of the future equity. So if you go into a home equity agreement and your property depreciates in value, then that investor will take a loss. So it doesn't.
Got it.
Yeah. So you're not obligated. And why are we hearing about this now? So I actually heard about this 5 years ago when um, I think it was what do they call those talking heads, right? Like Fox News and CNN, or they were talking about how institutional lenders are going to start going in and investing in people's equity. And that didn't really make sense to me because I didn't see how that could be that profitable. Now I see how that could be profitable long term, but I just didn't. It just really didn't make a lot of sense to me. But banks and these institutional investors are so savvy. I'm sure there's a good reason, and I'm sure there's profit in there somewhere. And I can speculate on how it could be profitable, but I actually heard it some time ago. I just didn't know what it was going to be called. And now I'm starting to hear about these HEAs or home equity agreements. But folks, if you're like me, you don't trust anybody, right? I don't trust any of this stuff. I don't trust banks. So, and I'm not a huge conspiracy theorist, but I think there's more to it than meets the eye. But I don't know why we're just hearing about it now because there's a really big push. Um, I don't know, but I'll ask. Though I've got some friends that are pretty high up at some banks, and maybe I'll speak to them about it.
Another question, Otis.
Hmm.
So the original amount of the investor's investment. So the investment is 20K,
Hmm.
and the value of the home decreases, but is the homeowner still on the hook for the 20K?
No, not if there's no equity, because the agreement is based on future equity. So if there
Okay.
is no equity, then the homeowners that's the risk for the investor. Right?
Okay.
Yeah. So I'm guessing just like any other entity that lends on real estate, they're going to look at how much equity is in it, right? They're going to have what would be compared to LTV restrictions, loan to value restrictions. So I'm sure that's going to be all they're going to evaluate all that. I don't anticipate these investors taking huge losses on this stuff. I think this is going to come back to bite some people, especially if they are in the home longer than they anticipated. All right. So if I get into this equity share agreement and I think I'm only going to be in the house 3 years and I'm in it for a percentage and I'm in the house 10 years, well, that equity could have increased significantly. And that could be a big dollar amount that you got to give up when you exit out of that property. So, it's got pros, it's got cons. But again, buyer beware, right? The more educated we are, I think the safer we'll be. Now we're talking about.
At that
Go ahead.
at that At that point, it acts like a mechanic's lien then.
I don't, not necessarily, because a mechanic's lien has nothing to do with the value of the home. The mechanic's lien just obligates you to pay that debt upon exit or refinance. Um, if when you have to settle, oh, you know what though? I bet that I believe there's a lien on the property. I don't know what
That's
that.
what
Yeah,
that's what I'm getting at.
yeah,
That's what I'm getting at. It's a lien.
yeah. It is. It has to be a lien on the property. I just don't know what it looks like because I don't know anybody who's done one. But I'll research that. That that'll be interesting. But there's going to be a lien on the property. But how can it be a lien on the property if you lose value? If you lose value, in order to make the lien legitimate, there has to be consideration. And if there's no consideration, then, and I'm not an attorney, but these are just, I'm thinking out loud here. If there's no consideration, if the investor takes a loss when you sell the property and you're not obligated to pay the investor anything, then how is that lien enforced? What does that look like? So that's good. That's a good question. I'll look into that.
Well, if you got, there's a revocable trust and there's an irrevocable trust. So this will probably be a tool similar to that. That would be my guess, is that once, if there's some consideration, then it must be paid. If there is no consideration, then the instrument is null and void.
Yeah. So okay. That's a very good point. So folks, now we're getting into contract law, right? And in order to make a contract valid, there's 4 elements that need to be there. One is agreement, right? There has to be an offer and an acceptance. The other is legality, so it has to be legal. The other is capacity, right? So you have to be of sound mind, right? And the last one is consideration. Those are the 4 elements to make a contract enforceable. Now, the consideration in the actual contract could be a future payment that may satisfy the consideration requirement. And I'm guessing, folks, I'm not an attorney, so I'm just giving it my best guess. But I could see how that could satisfy the consideration requirement. I just don't know. I'm gonna have to look at one and see what that looks at, what that looks like. But I know it's got to be a legitimate lien. But again, I'm guessing. I just got to read one and see. I'm sure somebody that I know has done it, and I'll bring it back to you guys, and we'll do kind of a follow up. Right now, I'm just trying to explain what it is. I'm not even sure if I would personally use that, and I also don't know if you could do it on investment properties. It's not something I've looked into. So, but we'll see. Now, advantage of a home equity line of credit, we already went over that, right? It's flexible borrowing. You only borrow what you need when you need it. All right. So if I do a home equity line of credit on my property and it's 75,000, as an investor, I'm going to take that 75,000. I'm going to go purchase another cash flowing asset and another cash flowing asset that I can leverage. And then when I leverage that cash flowing asset, and it's typically in the form of a refinance, right? I want to put permanent financing on that cash flowing asset because I want to be able to have projections and know what I'm going to be paying, how much it's going to cost me to own it versus the rental income that it's going to make. I'll leverage that, and then I pay back the home equity line of credit so I can use that home equity line of credit to go get another cash flowing asset. So the goal is to use the same money over and over again while leaving a trail of cash flowing assets in our wake, right? Now, disadvantages of a home equity line of credit. Variable interest rates. Payments can increase if rates rise. It is what it is. The risk of losing your home. Now, any debt against your property involves this risk, but defaulting on a HELOC can lead to foreclosure. Okay. Now, if you have a HELOC, a home equity line of credit, most of the time comes in second position. So typically people have a first mortgage, like all of those folks that got that 2.5% and 3% mortgage a few years ago. They're not going to want to do a refinance because they don't want a significant increase in their monthly payment because the interest rates are higher now. So it's perfect for them to go get a home equity line of credit. But if they default on that home equity line of credit by not paying their mortgage, right? Let's say they don't pay their first mortgage, but they do pay their HELOC. Well, the home equity line of credit, in order to foreclose, has to bring that first mortgage current before the lien in second position, which is the HELOC, can foreclose on your property. Now, are they willing to do that, right? If you have a $50,000 home equity line of credit and you're behind $20,000 on your primary mortgage, are they going to want to fork out that $20,000 to bring it current before they can foreclose? I don't know. It depends, right? Depends on the bank. All right. So risk of losing your home, and it requires strong financial discipline. So because the funds are easy to access, some homeowners overspend and then face repayment challenges. All right. And look, with anything, folks, you got to be responsible with that. You got to be responsible with that. And I can pull everybody's credit card statements in this room, and we can see who's responsible with debt and who's not. Right? It's easy to get in trouble with this stuff. All right. Closing costs and fees. So you might pay fees. You might have to pay an appraisal fee. They may charge you a setup fee. They may have an ongoing maintenance fee. All right. So those are the downsides of home equity lines of credit. So which one is right for you? Depends on what you want to do. I'm probably not going to give up future equity in my property because, a lot of folks, especially folks of a certain age, that's going to contribute to their retirement. So I still favor a home equity line of credit, but it's not for everybody. All right. So buyer beware. Okay. Buyer beware. All right. So let's talk about that. Let's say, let me close these notes down. It doesn't matter whether you're doing a home equity line of credit or a home equity agreement. How do we invest it? I always say invest in your education first. And, James and I, we talk about this all the time. The one drawback as a real estate investor and somebody that mentors a large number of people, the one drawback is just, you guys ever be right in the middle of something and you about to make a really good point, and then you lose your whole train of thought, like not just lose it, like Alzheimer, dementia lose it.
Out of there.
All right. The drawback of teaching people how to invest strategically and creatively is some people get into the real estate investing world thinking that they could accomplish all this with zero resources. And that is not the case. Just because something is possible doesn't mean it's likely. What I mean by that is just because you know how to pay for real estate out of your exit strategy so that you don't have to come up with a down payment and a lot of these upfront costs does not mean that you can form a business model around that, right? But it is smart for you to know how to do that in case the opportunity presents itself. It's just another tool in the toolbox, okay? Now, let's go back to basics because we're going to wrap up in probably about 10 minutes. So if you guys have questions, well, before we do that, let me do a quick reset. We've got some things coming up. If you go to our website, 4datapoints.com, you'll see upcoming events. But even more important than that, there is a guide that you can download that teaches you how to assess a deal using the 4 data points. 4 data points. What does it cost? What does it cost to fix up? What's it going to be worth when I'm done? How much income can it generate? Those 4 questions can take you to the promised land if they're used right. Again, they're not the end all be all of due diligence, but if you're looking at 20, 30 deals, or somebody comes to you with a deal like a wholesaler, and wholesalers are far more optimistic than we are as far as the performance of some of these deals, you got to be able to vet it. Okay. Got to be able to vet it. So if you go to our website, you can download that. It doesn't cost you anything. Typically, if I'm, at a hotel or speaking at an event or somebody, and I meet somebody, whether it's in the bar or the elevator, that's the document I give them. It gives the best explanation of what it means to be a real estate investor when you're starting out. Then you get to the advanced stuff later, but you can't get to the advanced stuff unless you can master that process. We're on we're on Clubhouse right now, but we're live streaming on Instagram and YouTube and Facebook. And this is new for me because I'm not really a proponent of social media, but it allows me to reach more people. So I'm keeping that in mind. We're going to be in Houston on the weekend of the 22nd of February. That is my birthday week. I will be 22 again. Actually, no, I don't want to be. I was stupid at 22. 31, I think I peaked out at about 31, 32. I will be 49, and I don't know what I'm doing for my birthday, but I know that we're doing a real estate investing workshop at the Hyatt Regency and Hyatt Place. So Friday the 21st, we are doing a meet and greet at 7 p.m. We'll go a couple hours, and then we're doing the workshop Saturday. And then after the workshop, everybody is, well, the folks that have those tickets are going to come up to my suite. I'll have it catered for you. I am going to have an open bar up there, and so drink responsibly. All right. Now, my workshops, uh, everything's a gimmick nowadays. Can I just say that? Everything's a
Yeah.
gimmick. Everybody's it's a big money grab, everything. And I don't trust anybody. And I encourage you guys not to trust anybody, right? Make sure you verify before, even if you're just giving a $1 away, make sure you verify it. Make sure you ask questions. If the person you're asking all these questions to gets offended, that is not somebody you want to work with anyway. I love when people vet me. I love when people ask me the tough questions. It's the only time I get to brag on myself without sounding like a weirdo. My workshops, I'm very intentional about how I put these workshops together. I teach. Okay. It's not like a typical real estate investing workshop where they have in the back of their mind, they got something they want to sell you, but they'll do a free workshop, air quotes, get everybody out there and get you excited about the possibility of this lifestyle that you could have with real estate investing. I don't think money is the only thing that could improve your quality of life. So I don't really harp on that stuff. I'll let the math show you how much money you can make. Right. And I also teach you the strategy so you can see how likely it is for you, given your current situation and your future situation. So I don't try to make somebody, convince anybody of anything. But my goal is to make sure that when you leave there, whether you sign on with our real estate family or not, you can accomplish something, because that's the best marketing for me. Once you come to one of my workshop, now your name is associated with Otis's name, Otis Douglas James III, 4 Data Points Academy. So I can't have you out there, not knowing, just going blind and, trying to figure stuff out. So you will learn something at this workshop, and I will give you materials to take with you, so that you can refer back to, because if your memory is like mine, by the time we get to the third topic, I done already forgot the worst. So just food for thought, right? For anybody that wants to do that. You can get tickets on our website. I'm going to max it out at 30 people. I think we're close to the limit now. We may go over if, we get some people that are just really adamant about being there. But I keep it small because I need to be able to interact with everybody and make sure that they understand what I'm teaching. I'm not teaching just to be teaching. I'm teaching so that you can get something of value, something that they can never take away from you. Right? Amen.
Hey,
Yes, sir.
we have a question? Or
Yep.
and then chat. Karen, what's up, Karen Scroggins? Was the class at the roundup a quicker way, I'm assuming a quicker way to process than the 4 data points?
Was the class at the Karen?
Yeah, Karen Scroggins.
Yeah, she's in our real estate family. She was we have so what she's talking about, folks, is when you join our real estate family, we have virtual classes, but we have something called a Monday roundup, which is just our time for me to give extra support to people if they need it. Sometimes I'll just draft up a new lesson and I want to teach it. And there's a lot of people that already went through the curriculum. So it's a way for everybody to get the new lessons and just kind of brush up on, skills. And what we did Monday was I made everybody find the 2 data points, number 3 and 4. What is the property going to be worth when we're done? And how much income can it generate in the 1 to 4 units? So I think that's what she's talking about. So I'm not really understanding the question though. Karen, come on up here, Karen. Come on up here. Let me see. See if I can read it. Okay. Are you? Where'd you get that question from, Tavares?
Oh, from the chat. And then, of course, Ice says, is this going to be an invest off in your suite? Ice, you crazy for that.
Invest off.
An invest off.
Shout out to Diddy.
I'm dead.
Yeah. You know what? We may talk about a little real estate, but we just play music, meet each other. We have people that sign up for our real estate family at a lot of these events. And so that gives them a chance to meet some of the people that are already in the family. I always want to have people that I'm already working with around, so people don't have to just trust me, right? You want to put people in a position where when they're ready, they see the value in it and they already know, which is why I teach before most people join, right? Because is that Russ Lane KD? That's a sharp brother, man. I like that guy. Y'all make sure y'all check him out. So I make sure that when I'm teaching people that they they understand that I don't have a secret agenda, right? I believe in 100% transparency. We put all the prices on our website. Our contract, we go into contract with people, and if you look at the contract, like if you took it to your attorney, he would probably tell you that it's really lopsided in your favor, because we established this to create real estate investors, not to see how much money we can make. So I love that, and I think that's why I have the reputation that I do, because I just look, folks. Hold on 1 second, Tavares. Real estate investing is not the end all be all of the world. Okay. Yes, you can make a lot of money. That is not the thing that's going to improve your quality of life. Okay. I've been in real estate in some way, shape, or form my entire life. I've been exposed to it. My father was since the 70s. He's been in it. You can have a great life making $60,000, $70,000 a year if you live your life right. I've made a lot of money in real estate in certain years and had my personal life in shambles, right? My personal life was just in shambles, going through some very dark times that I created for myself, and all the money in the world didn't help, right? So that's part of the reason why we're really, I go slow when I'm teaching somebody how to invest in real estate. And that's why we don't have an end date. That's why we do the fundamentals. And then I support you when you're out there doing the practical application of what you learned. And I know that your situation is going to change in 6 months. It'll change 6 months from then, and I'll still be here. It'll change a year from then, and I'll still be here. It'll change 5 years from now, and I'll still be here to give you support if you need it. But I don't think you're going to need it in 5 years. If you do, I didn't do my job. But I still want you in our real estate family, because maybe we collab and build something together, or maybe we go into some communities and create opportunities for people. And maybe we who knows? Once you're savvy, now I have all these trained real estate investors that invest with integrity, which is a big thing, right? So I love real estate. It saved my life. It changed my life, but it doesn't. It's just a means to an end. It's not. It's just a tool, right? I'm not. I don't want it to seem like I'm not passionate about it. I'm passionate about other things. This real estate stuff is just. It's a way to pay the bills, right? It's a way to pay the bills, and if you got demons, look, more money is just going to make them demons a lot stronger. So, I don't want to. I don't want people to. That's why you guys don't hear me talking about the lifestyle. Right? The lifestyle. What is the lifestyle? You get to determine your lifestyle. I don't want to go off on this tangent. This is off topic. I see people. I just see people chasing the wrong stuff, man. And look, all right. Let me stop. Let me stop. Yeah. So all of our information's on our website, folks. And if you guys want to learn, and you want to learn the right way, I suggest you vet me first, right? Talk to people, go to LinkedIn and see what I've done, check my licenses, and check all this stuff, right? Check all this stuff. It's okay if you talk about me behind my back. It's all right. No one's going to say anything bad. All right. Dorothy Connor says, the higher the level, the bigger the devil. Amen. Amen. Ugh. Boy, we should have a room. We used to do the clubhouse rooms on some of the Sundays. I'd get in there, and we would get ready to start the room, and then I'll listen to some gospel music, and the Holy Spirit will come in and say, you know what, forget that room right now. There's more important things that you need to share. And that was some of the most fulfilling stuff that I've done in this real estate space. Um, Somebody told me, they was like, "Oh, did you always talking yourself out of some money?" Some money. All right, let's get back to it. All right, where were we? All right, so this is what I would do. Oh, go ahead, Tavares. I'm sorry, I cut you off.
Oh no, we're good. We're good. I already put it in the chat. I said real estate investing is a process, not a goal. So
Yeah, man, it's just like anything else, right? It happens to be my life story, so it's easy for me to teach it.
And then Karen says, by the way, she says, don't forget that call today.
Yeah, I'm gonna call Karen's brother and let him know that I'm not fake. I'm taking care of his sister, right?
And then Catherine says, Do we have any deals to invest in? She wants to make some money.
Yeah, I have plenty, but get to know me first. I get really nervous when, we don't have a pre-existing relationship and we start talking about deals to invest in. It's not that I don't want to include people that aren't in our real estate family, but I have to look at optics, right? How does it look? Even though I have the best intentions and everything would go smoothly, I don't want the narrative out there to be like, oh, Otis is soliciting people to do deals. That is not the case. So I like to train people, and I also like to let people get to know me first, see how I work, see the level of integrity that I work with, so there's no anxiety. So yes, we have deals that internally that we put groups together and we go ahead and do, but you got to be in our real estate family, and I'm not saying that so you'll sign up. I'm just being transparent with you. But yes, it's almost like printing money. We only do the 1 to 4 unit stuff. The commercial stuff, there's too much risk for me to do those on an ongoing basis. So yes, we absolutely do. And folks, all of our stuff can be found on 4datapoints.com. I love talking about real estate all day. I don't even we're live streaming, so I think this one's gonna be up no matter what. But we messed this up from Jump Street. We're not going I said we're not gonna put it up, but I think I got no choice.
Might as well.
You might as well. So we're gonna wrap it up in a few minutes. I'll take any remaining questions, folks. The questions can be as hard or as simple as you want. There's no dumb question. If you have the question, somebody else probably does too. So
Yeah. Hey, brother Otis. I think I think you did a good job today, man. Yeah, I think put it up.
Right on, man. Right on. I appreciate that. I
found the 4 Data Points website. I got to save to my desktop on my phone. We're gonna definitely delve into it.
Amen.
But I just want to say that I'm in the process of applying for a HELOC now for 50,000.
Okay.
I may increase it, but it was like I have this whole list of questions that I asked about the loan, and there was no down payment. So then I looked into it and I saw that there's no down payment unless you settle the loan within 3 years. And at that point, I wanted to know what closing costs actually were, and I was surprised that it was only like $1,000. So I said, okay, this sounds good. But I thought it was a catch. Like, what is the closing costs? What happens if 3 years down the line I decide to sell it before 3 years, or close or settle the loan? So you have to pay the closing costs, within that 3 years if you settle before that 3-year period.
Yeah, it's just like anything else, right? You gotta shop around. Like there's a lot of institutional investors that aren't necessarily banks. A lot of them are private investors, so they have their own rules. Then you have conventional financing, and these banks answer to Fannie Mae and Freddie Mac. So Fannie Mae and Freddie Mac, these government agencies set the guidelines because they buy these loans back from these conventional banks. And then you have asset-based lending, which is a completely different process. They qualify you based on the equity in the property, or primarily the equity in the property, or the income that it generates, depending on the product. So and you could do seller financing, and that seller may have a completely different set of rules. So the goal is to get educated so you can look at everything and see what the best way forward is, right? Keep in mind, folks, look, education is something they can never take away from you. They can never take that away from you. And it's going to keep you from getting taken, right? It's going to keep you from getting taken. Unfortunately, some folks that are in our real estate family that came from other places, they were in other mentorship programs, and they got they got taken, and they didn't ask the right questions. And it is what it is. So just knowledge is power, right? My people perish for lack of knowledge. That's something that's probably more valuable than any asset you'll ever purchase. So knowledge. Even if you don't do anything with it, you'll be ready when an opportunity presents itself. Amen. All right. Any other questions, Tavares? You can do a check for me.
Yo.
Nope. No questions. We good?
Nope. We're good.
All right.
I got a question.
Remy, what's going on, brother?
What's up, man? Good morning to everybody. Happy almost into January, going into February. We almost in that Black History Month. Listen, excited to be here, man. All this wealth of knowledge. Hey, man, I literally just sent you a deal that was brought to me yesterday, and I kind of want to get your perspective on it, man. I just actually texted you the information. It's a property. They're asking for 360 for it, but they're open to seller finance. But this is the thing though. So I want to take. It was something that you mentioned, bro. I don't know if you remember. You said this like a couple of, maybe about 6-7 months back, man. But the guy was basically saying, he said, I have a friend wanting to rent out his house. He said it's a 3-2 in East Austin, owner financing, 15% down, flexible on interest, right? And then they were saying, hey, they looking to do a wrap, and they said we could do it like a balloon payment. And I remember you said balloons are for clowns.
I didn't say that. I don't think I said that.
Yeah, you did. You said balloons are for clowns. So every time I hear balloon payment, man, like that's how I respond. And I just say, nah, just get it. But I sent you the property. It's 1903 Renegade Drive, and I want to see if we can kind of like do like a maybe like a live assessment of it, if that's cool.
Okay. Well, hold on. Let me clarify a couple things first. So no, balloons are not for clowns. So if I said that, I think I was just being funny. I don't recommend balloon payments because unless you understand how to use them. I don't mind a balloon payment if I plan on exiting out of that asset before that. So as long as you know that the balloon payment is there and what it does, and your plans incorporate that balloon payment into them, then I think you'll be okay. Just like anything else, you really got to manage that process. So, and also, as soon as you said 50% down, I was already turned off. And the reason is because you got to weigh the opportunity cost.
No. 15.
Oh, 15. Oh, I'm sorry. Okay.
Yeah.
So,
yeah.
Okay. So 15%.
But they asking for 360. So that's like right around like 55,000.
Yeah. Something like, okay. Yeah. So something like that. So now you got to ask 4 questions. What does it cost? 350,000, right?
Yes, sir.
Okay. Is there any rehab costs?
No, man. It's literally turnkey. It's ready to go.
Okay. What's it going to be worth when you're done? 350.
I know that it's right. Yeah, it's gonna be right at that 360 because when I ran some comps in the area,
that's good. That's
they're
good.
around that same range.
That's good. Hold on a second.
Okay.
So how much income can it generate? How much can it rent out for?
Right now, around 19 to 2,000.
19 to 2,000. It's not going to rent out for enough to service the debt. I doubt it will. I would run the numbers to check, but so there's 2 things. It's not going to cash flow enough for me. And because the purchase price is so close to the market value, there's no way to add value. I have to add value to make my profit. So that's a long-term hold. And if it's a long-term hold, it's going to have to cash flow better than that will. Now, also remember, there's an opportunity cost for that 15% that you're leaving in there. My criteria, I want to get all my money back out of the deal so I can use that money to buy more cash flowing assets. So the opportunity cost for me is not going to be the same as the opportunity cost for somebody else, because they may not be in a position where they can generate that type of income off of that amount. So you would have to weigh that out for yourself. And I'm speaking to everybody. It always depends on who you are and what you do and what you could do with that money outside of that. So it's not a profitable investment for me. But if it was my personal residence,
he went mute. He'll be right back.
Oh, is that me? Is that me or him? Can y'all hear me?
I can hear you.
We can hear you, bro.
Okay, all right. Yeah, so it just wouldn't be profitable enough for me because I don't want to leave my money tied up in that property like that. And if I did, the return, the cash flow monthly would have to justify me leaving my money in there. And I can already tell that 15% down, you're financing 80%, interest rates are above 6%, let's say 7%. And you're paying principal, interest, taxes, and insurance, and trying to recoup that in the rent. If you recoup it in the rent at all, it's not going to be by much. So it's just not, it's not a good investment. But if you're somebody that, wants to move into the property to live there, and you can beat out the competition, maybe, but it's not, it's not, I don't even have to run the rest of the numbers on that. Amen.
Man, church.
Yeah. All right, folks. I've got a 3-year-old walking around the house with diplomatic immunity out there. We may do this topic again. Some of you guys had some good questions. I'm going to go research for the home equity agreements. You guys gave me a couple things to consider, so I'm going to go research a couple of those things, and we may do a part 2 of this. But other than that, look, hey, what's up, Rose? I just y'all pulled Rose up here and didn't tell me she was up here. We're going to wrap up, and all of this information, everything that we're doing is on our website, 4datapoints.com. The number 4, DATAPOINTS.com. I'm not a good speller. I've just said that 1,000 times. And pay attention to our upcoming events. I'm going to be putting some more events on the calendar for later this year. But look, we're about turning people into real estate investors, right? Period. And, even if you're working a W-2, 90% of the people that I mentor are working W-2 jobs. And a lot of those folks enjoy those jobs. And I teach them how to invest from a distance. I teach them how to invest and not have to physically be there. I teach them how to keep their job, right? I kept my job. I was investing when I was in corporate. I was in the multifamily commercial industry at the corporate level, and I liked it, man. I liked it. So I don't recommend just jumping into real estate investing. Get the education first and ease into it. Ease into it when it costs you more to be at work because you're losing money on the real estate investing side, right? You got income from 2 places and one is eclipsing the other. Just keep that in mind. Right? We don't want to put anybody in a bad position. Also, our entry level is $5,000. If you don't have $5,000 and can't come up with $5,000, and I'm not talking about taking $5,000 from something that's important because you think you're going to come and learn how to buy real estate with no money and then make a profit. Do not do that. We've had to turn away some people because we felt that they were taking, their financial situation was worse than they were, making out. Right. So we don't want that stress. We don't want you to be stressed. We'll still be here, right? If you don't have it now, we'll still be here. Don't put yourself in a financial strain to join our real estate family. It's just it's not worth it, right? It's not worth it. Also, what else? Follow us on the platforms, right? Instagram and YouTube. Again, shout out to that one person that subscribed on YouTube. I'm gonna send you a gift basket. I really appreciate that. Other than that, anybody got any last minute questions before we get out? I'm so quiet.
No more questions. Tanisha just said that she was viewing the property online right now, and she said it looks brand new. Wow, this is a very beautiful property. But that's about it. Everybody have a great day.
All right, everybody. We are out. 4datapoints.com. I would back up, but my ankles is ashy right now, so I gotta shut it down before I back up out of my chair. So let me go ahead and end the live stream. All right.